Well, let's jump in. Again, thanks for joining, everybody. My name's Caleb. If you've joined some YCharts webinars in the past, you might recognize me, but I'm not why you're here. Joining me today is Brian Portnoy, and super excited to have you on, Brian. If you're not familiar with Brian, you should be. Brian's the founder and CEO of Shaping Wealth, and a big part of what you do over there is something that we'll talk about today, which is behavioral finance. So we'll get into that. Before we do, I am going to go over a quick couple of housekeeping things. So first of all, we love getting questions. We'll do our best at the end of the webinar today to address some of those questions live. And the best way to enter those is with the chat function or Q&A function there right within the Zoom webinar screen. So as those questions come throughout the whole webinar, just go ahead and type them in there. If we happen to see them, maybe we'll tackle them on the way. But if not, we'll try to get to those at the end. So that's how the question and answer works. Also, you will get a recording of this webinar. So if you have to drop early for some reason, or if we're not engaging enough and you want to catch us on replay, you break our hearts, but you can watch the recording. That'll be on our YouTube channel. It'll also get emailed to you. YCharts YouTube channel, if you subscribe there, it's a great way to always get the most recent videos and stay abreast of all the content that our marketing team is putting on there as well. So please click subscribe when you're there. But let's get into today. So quick agenda. For anybody that doesn't know, we're going to get Brian to give us a quick take on exactly what behavioral finance is. And we're going to learn why that communication piece between the advisor and the client is so important in the relationship and in also the longevity of your success. Then we'll talk about recent market trends and how to communicate about those recent market trends, if you should communicate about them, and what your clients are probably thinking or feeling when you have those conversations. And then, like I mentioned, we'll try to save some time for Q&A at the end. So, Brian, if you could, for those that don't know, can you give us just a quick debrief on what behavioral finance is, and maybe weave in at the same time a little bit about Shaping Wealth and how you're doing this for a lot of advisors and being their behavioral officer?
Absolutely. Thanks to you, Caleb, and all YCharts. We just appreciate the opportunity to come and chat about things that we care very passionately about. So what is behavioral finance? It's a career that I've devoted myself to for a long time now, and it's maybe a fancy term for the psychology of money, or the psychology behind money decisions. For those who don't know the backstory in a line or two Israeli psychologists in the 1970s started writing about decision making. They looked at the American economics profession and said, those guys don't know what they're talking about when it comes to how real human beings make decisions. So two guys, Kahneman and Tversky, invented this field called behavioral finance. And fast forward to now, there's multiple Nobel Prizes like Danny Kahneman and Richard Thaler. There's movies about baseball starring Brad Pitt, like Moneyball, that are about basic behavioral finance concepts. So behavioral finance has arrived, and it really boils down to how do we as real human beings make decisions about this incredibly complicated thing called money. The challenge, or the first roadblock, is what we all learned in Econ 101. The idea that as human beings, we are fully informed. We have complete information. Our preferences are ranked clearly, and we understand what those are when we're out in the market choosing things, whether it's stocks or food or automobiles. We know exactly what we want, and that we make rational decisions based on those clear preferences. And as I put here, nope, that's simply not who we are. And Dick Thaler, I'm in Chicago on the north side. Dick Thaler's on the south side at the University of Chicago. And my favorite line ever about behavioral finance is what he said: people aren't dumb, the world is hard. And as you guys know at YCharts, we live in a world of endless data. There has been no point in recorded human history at which we've had more information, more choice, more data. It's not clear our brains were wired to make great decisions in light of this overwhelm. And a lot of us are on tilt, not only analytically, but emotionally. And so I think we need to give ourselves and our clients a little bit of space and a little bit of grace and just say, hey, it's really hard times. We're not irrational, which is sort of an economics word for stupid. So we're not dumb. It's just we're dealing with a really difficult game to play. And I'll just wrap by saying that, the way our brains have evolved over many, many years has been to adapt to the environments that we live in. So we might think about, the traditional behavioral finance literature, the ways that we're biased in lots of ways, but behavioral biases are not necessarily flaws. They're actually hallmarks of what it means to be human. And so how we see the world, how we see ourselves, how we take risk, there's complexity here, but we can simplify it by saying that, we see the world in a way that is going to make sense to us. We are born to be pattern seekers. And so when you have new economic data that doesn't map with where you've been, which we're going to talk in detail about, you've got challenges. And so something known as confirmation bias sounds like a flaw, but no, we're just looking for the world to be stable and understandable, how we see ourselves, basically our identity. We have an attachment to certain identities of who we are in the economy. We're buyers, we're sellers. And so the way we process information maps to that. And then finally, how we take risk. Generally, there's this principle that we're going to touch on a few times today, known as loss aversion, which is a simple but super profound idea that losses are more painful than gains are pleasurable. And so when you go to a casino and you make some money, you feel pretty good. But if you lose that same amount of money, you're going to feel disproportionately worse. So we're going to take this perspective on what it means to be a human being into, I think, a lot of what's going on now in the markets, which we're going to show are really kind of different and interesting and anomalous.
Awesome. I'm excited, Brian. This is going to be fun because we spend a lot of time in YCharts looking at data and making tools for our clients and people who use YCharts to look at data and analyze what's going on with the markets and the economy. We answer a lot of questions for people about what's happening. Maybe people trying to figure out what might happen next or what's happened in the past. But there's a couple questions that we probably don't spend a lot of time talking about here at YCharts. So I think when we pair some of the data that we look at with some of these questions that you focus on, we'll have a good conversation today. But go ahead, touch on these two because I think they're going to come up a lot.
Yeah, they're going to come up a lot, and they come up with all the time to us, often subconsciously. If what we're really talking about here, Caleb, is human-centric advice, human-centric planning, we have to recognize that we are asking the same deep questions of ourselves and our loved ones on a daily basis. And, shaping wealth, we provide coaching and content to financial advisors all over the world, programming on financial well-being, not only how your clients can achieve it, but how you yourself as an advisor can achieve what we call funded contentment. And we talk a lot about so-called questions behind the questions. So if someone's asking about, hey, are we in a recession, or why is inflation so high? They might have some interest in kind of the technical answer, but usually those technical questions are hiding the question that really matters. And in my experience, 10 plus years of doing nothing but working with, coaching, and advising advisors, there's two things going on. One is, am I going to be okay? And the second is, how much is enough? And this sort of maps to what I call the evolutionary two-step. What we need to do from an evolutionary point of view is survive and then thrive. So every day we need to survive, and hopefully some days we thrive. So the survive part is, am I going to be okay? Are my loved ones going to be okay? That's often the question behind the question. And then, sort of keep your feet on the ground, but keep reaching for the stars. For those of old enough to know a Casey Kasem reference here, how much is enough? This is something that we all struggle with because in the biggest of pictures, we live in prosperous times versus 100, let alone 200 or 1,000 years ago. And so this problem of enough in the context of general abundance is something that we see in coaching advisors and their clients come up every single day.
So answering both of those questions is really probably just a formula to say, how happy can we make our clients, or how happy can we be if our financial picture is where we need it to be? But you've got a really interesting take on happiness, and I'd love to have you spend a minute talking about that too.
Yeah, no, thanks. Happiness equals reality minus expectations. So what does this mean? To me, it's a simple, but I think powerful, we'll call it an equation that kind of gets the advisor and client communication process moving in the right direction. Again, I have worked with thousands and thousands of advisors over the year. 99 point something percent of them, in my perception, care deeply about their clients' well-being. They want them to do well. They want them to thrive and be happy. Well, how do we help them achieve that happiness? It's unfortunately just not a number. It's not, oh, if we can get 6.8% annualized returns versus 6.3%, then we will have crossed the threshold. No, it doesn't really work that way. There might be data, but there's a story that wraps that data. And a lot of the happiness that we feel, not just in our work as advisors and investors, but just who we are in the world, it's based on expectations. The brain is hardwired to always be thinking ahead. Human beings are one of the reasons we're the most successful species on the planet, is that we have the ability to anticipate and think long-term in a ways that almost no other species do. And so the simple equation here is that when the world or outcomes exceed what you thought was going to happen, you're going to be happy, if only for a moment. And if the outcome falls short of your expectations, then you're going to be sad. It's more complicated than that, but maybe not really. And so what do we have control over? Well, that's a bigger question we don't have time for today. Can we control reality? Well, we have some control over the decisions we make, but big things like the weather or the stock market, we have no control. That's sort of fixed. But we do have a lot of control over expectations. And we believe that one of the most important foundational roles of the modern advisor is to set and manage expectations for all dimensions of a client's money life. And so as we kind of dive into some of the data, we're going to tell expectations-based stories. And if we could be a little bit more precise, a little bit more clear in being able to articulate what those expectations are, well, we're going to achieve higher client satisfaction. And that's going to lead to all the great measurable outcomes like, wallet share, retention, referral rates. So that's where we're going.
Yeah, I like it, Brian. And this, we're going to come back to this a lot, I think.
Yeah. This is our
talk about different variables within this equation.
This is our decoder.
I like to.
Yeah. I was going to say, this is our decoder ring. Like this one thing, happiness equals reality minus expectations. This is going to be our decoder ring or skeleton key through a ton of data.
Yeah, and I like to think about that reality variable in this equation as something that you maybe can't change it too much, but you can inform people more about what reality is.
Mm-hmm.
I think that's a big part of what YCharts tries to do in helping people see the big picture and seeing all the different components of the economy and the market. So hopefully I can touch on that a little bit as we go, and then you can use that decoder ring to tell us how happy or unhappy that's going to make people when they realize.
Awesome.
But I'm glad you brought up the whole concept of communicating with your client, because that's something that is a pillar of what we know. We support for our advisor clients do with their clients here at YCharts. It's so important that we've now, for the second time in the past several years, done a survey where we submit this survey out to not to advisors, but to clients of advisors, so people who have portfolios that are managed by financial advisors. And the point of this survey is to find out how important communication between the advisor and the client is and what they're looking for in that communication. And we most recently redid this survey in the fall of last year, and it was our first time since the pandemic doing that. And there were three kind of big findings here. And I want to hone in on these three findings just to kind of frame the concept and try to start to quantify how important this communication piece is. The first one is that since the pandemic, clients have been much more active in leaving their advisors. I think about 25% said they considered leaving, and another more than 25% actually did leave their advisor and go to either a new advisor or to some kind of automated, robo or something like that in that time period, which was a huge increase from what we saw before. And they cited several reasons for that, which will actually, they're summarized here, but we'll talk about those on the next slide. But the second 2 points here are that the way that advisors can maybe help that attrition from happening is by having a communication strategy and by making sure that their communication with their client is frequent and proactive enough. And again, there's a lot more here, and we'll share these slides with everybody so they can read in. But the survey really emphasized that not only is what you're doing for your clients with their portfolios, with their financial plan, with how they're investing super important, but how you're communicating that and how you're kind of building that value through the relationship is monumental to keeping those clients around. So if we can just touch on, and I move the slides in the right direction here, a couple of these reasons, right? So the biggest reason that people responded for leaving their advisor's portfolio performance. Now, you mentioned a minute ago that happiness is not a 6.8% return versus a 6.3% return, and obviously those positive numbers are easy to talk about. The negative numbers, which we may have seen over the last year, but I'm having a hard time believing that it's just the number on the statement that's making that happen. What's your take on this piece and what that actually means between the relationship between the client and their investments and the advisor?
Yeah, I think you're generally going to see that portfolio performance number rise in importance during worse times. And last year, we saw a very anomalous market where stocks and bonds markets were both down double digits, which is borderline unprecedented. So that's going to increase in importance. Last year was very much a fear-based market, and there was a number of sort of connecting pieces that drove that fear. So it's not surprising that something someone would say is performance is bothering them. And in part, it looks like the numbers are going down. What does that mean for the life that I want to live? And, it's going to be one of our constant themes here is going to be the question behind the question. Okay, that number looks really scary. What does that mean for my ability to lead the life that I want for me to support my family or my community? To that first of two big questions, am I going to be okay? You can see, though, in 2019, but also ranking high in 2022, deep understanding of me and my goals. This is important. My experience is that many clients of financial advisors aren't going to their advisor for a market update. They're not calling in every week or month to be able to understand what the ticker says. No, they want to have, they've got challenges, they've got problems that they want to solve. And, back to this theme of human-centric planning, people want to be seen, they want to be heard, and they want to be understood. So, a lot of the coaching we do at Shaping Wealth happens to focus on things like empathy. And, we're a left brain industry. Spreadsheets, numbers, charts. Many people on this call have an MBA, a CFA, a CFP, all those good things. But when you flip the switch on your right brain, you're dealing with self-awareness. You're dealing with, perception of other people's emotions. And so a lot of people show up in that advisor meeting or that advisor call just wanting to be heard. They want to be given permission to talk about the things that they really want to talk about.
And just to take it back to that equation, right? Maybe the portfolio performance that's being cited here is just how different it is from expectations, or how expectations may be needed to be better portrayed to kind of maintain that client. And I guess as we transition into talking about that and talking about everything that happened in the market, I think there are a few other, you mentioned a couple of these words already, but a few others that you think really capture the story for what happened over the last year plus, and how that's making people feel. But talk through the few keywords here before we get into some of the more charts and data focused part.
So in talking with our clients who are financial advisors, but just being in the community, last year was hard. It was hard on multiple levels. And so I want to acknowledge that, to express that. And in any profession, it doesn't matter if you're a financial advisor or a football player or a car salesman or whatever, you kind of want to know what's going on in your industry. What are other people thinking? Well, I can share that across many conversations, advisors found it very difficult to sort of navigate the narrative, the story of 2022, and for good reason. And so we got a lot of data coming. But last year was really weird, Caleb. I mean, we saw things that we haven't seen in a long time. And back to the way we're wired, the way our brains sort of the way cognition and perception work, we're always looking for data points that reinforce the things that we already believe to be true. We sort of show up with a series of beliefs, and then we cherry pick the stuff that makes that story even more whole. It's not just intellectually, it's physically uncomfortable to confront evidence, stories, data that contradict what it is that you formally believe. So because of last year, and we're going to go through the stock market, the bond market, the housing market, inflation, what was going on in the tech space, and so on and so forth, hard to wrap our brains around it, a little bit chaotic. I mean, truly anomalous in some ways. It's been decades or even a century since we've seen some of this before. And we as people, we don't do different really well. We like to see a nice slow accumulation of the same. That's very comfortable. And when you see these strong right-hand turns or left-hand turns or ups and downs, it is not only uncomfortable for us, it makes telling the story to others that much more challenging. So I hope everybody in the audience, who's listening in or watches it on replay, gives themselves a little bit of grace in knowing that last year, in terms of telling the story, it was probably the hardest storytelling year that we've seen in memory.
Yeah, and I'm glad you honed in on hard to explain. I think that's the one that hopefully we can keep coming back to here as we go through some of these charts and some of these pictures of what's happening in the economy, because hopefully, via some of these pictures of the data and the perspective that you have on these different topics, we can make that a little bit easier.
Yeah,
So
and just sorry to cut across, it ties to our decoder ring. So hard to explain ties to the expectations piece. So if part of what we're doing as communicators and coaches and counselors and guides and advisors is explaining things when it's inexplicable, well, our job gets harder.
All right, so let's jump into our first topic. And this is, the big one that everybody was talking about last year, right? Certainly not groundbreaking. We're talking about the downtrend that we saw, not only in markets, but also in the typical, historically diversified portfolio. And, I'll kind of walk through what's in the chart, and then I'll turn it over to you, Brian, to talk about maybe how, why, and if advisors should become communicating about this topic with their clients. So the top half of this chart, we just have three lines. One's showing the S&P 500, one's showing the Bloomberg, aggregate, and one's showing a 60-40 portfolio. And if you're saying that font's too small to tell which one's which, I think that's okay, because in the time period we're looking at here, they all kind of did the same thing, right? Which is what's captured in the bottom of the chart there, which is the correlation between those three indices, as high as almost one. So almost perfectly correlated, over that year period. So that correlation started to break down a little bit here in the last month or so, but turning it over to you. So how, why, if, what's the story here that we could be talking about?
Boy, I'm gonna try to keep it short, because this is just about my most favorite behavioral investing topic. I've been writing about this for a long time now. In fact, I wrote a piece for Forbes in 2015 called "Diversification Means Always Having to Say You're Sorry." So and making a distinction between the math versus the psychology of what we all learned from Harry Markowitz and the textbook on diversification. You buy something that zigs and something that zags, and it ends up giving you a smoother, good return over time. Lo and behold, it never really works out that way in practice. And last year was an extreme case of diversification not working. Usually what you have is some things are up, some things are down, and you have to explain, well, why do you have something in your portfolio that's not that's not going up? In this case, everything went down at a relatively high correlation. So we're having to explain in a very difficult way to our clients, well, if stocks are supposed to go this way and bonds the opposite way, and it combines into a nice diversified portfolio, well, what we've had to do for a little bit of time now is throw away the script. So The correlations, as you say, have broken down a little bit, but we typically think of stocks and bonds as not very correlated, and lo and behold, that story has not played out for quite some time now. So the diversification story in terms of managing expectations, I would argue, has never been more difficult.
And I guess to put that into numbers, right? Because I think sometimes when we're looking at charts and analyzing data, we focus on percentages and drawdowns. And maybe when the average investor is looking at their portfolio, they're more focused on that number. So what does that actually mean? If you started 2022 with $1 million portfolio, that 60/40 portfolio probably drew down somewhere well below $800,000. Is that number and understanding how those numbers make people feel important to differentiate from the percentage figures that we talk about a lot?
Yeah, I mean, we have a different psychological reaction with percentages versus integers, actual numbers. I mean, there's something very real about $1 million becoming $790,000. I mean, that's when you're sweating. That's when you're really wondering, am I going to be okay? Forget the question about how much is enough. You're just hoping you can keep a roof over your head, that you don't have to rewrite your retirement plans, that you can still support your family in the way that you want to. So, to the theme that last year was an extraordinary fear-based market, this is just a powerful slide that puts numbers to that and validates that this was real and this was very difficult.
And then the last slide we have here on this topic, I'll explain this one because it's not immediately obvious when you look at it, but the intent here is really to think about somebody who's in the phase of life where they're contributing to their portfolio versus someone who's in the phase of life where they're taking withdrawals or income streams from their portfolio. So at the top, we've run a scenario here in YCharts that we said you started with $1 million portfolio, you contributed $1,000 a month to that portfolio. How much money did you have, if you started with $1 million in January 2022 and take that up to a couple of days ago? It's less, right? Even though you've been contributing, it probably doesn't feel good to be putting money into your investments every month and get your statements and see that number a little bit lower. But, to me, that number is not, stark enough to really upset you. Whereas in the second scenario here, and the top is a 60/40 portfolio, the bottom one is actually a 20/80 portfolio. So only 20% of that bottom portfolio is in equities. The rest is in bonds to represent somebody that may be in an income generation phase on their portfolio. And that same person starts with $1 million, taking $2,000 a month out of their portfolio. At one point, that portfolio that they're probably relying on to have a pretty steady balance was as low as almost $800,000. How is the psychology different between somebody that's in the accumulation versus distribution phase of their investing, and how does a market like last year kind of really strike them, differently?
Yeah, I think there's a profound coaching moment here for advisors in working with their clients to truly understand who they're working with. If you recall one of my early points, adaptive mindset leads to questions as to how do we see the world? How do we see ourselves? How do we think about risk? This is the second one. How do we see ourselves? And the word that I would sort of thumbtack to this slide is identity. There's actually two phases of life in this context, the accumulation phase and the decumulation phase. And those feel very different. It's one thing to have your career ahead of you, you're working, you're saving, you're investing, you hope the market goes up, you see the balances go up. And then at a certain point, you decide to stop working, or you have to stop working, and you enter a different phase of life. This is not, it's an accounting challenge. It's a portfolio challenge in a relatively narrow sense. We could see the numbers and they make sense. But from a deeper perspective on who we are and how we define ourselves, that shift from the accumulation mindset to the decumulation mindset is one of the most underappreciated behavioral finance topics that we know, because we change. We're almost forced to change even if we don't want to, which is actually why we see a number of emotional, even mental health challenges early in retirement, because you've been asked to lead a life very different than the one you've led for 40 years. Throw on top of that, Caleb, the data that you're showing, and especially the bottom panel, and people are in a world of hurt. So appreciating that this isn't just an accounting dynamic, but it's a dynamic tied to our identity of who we are, hopefully creates a space for that much better, deeper conversation with the client and really helping them define their goals on a going forward basis, not just in the abstract.
And Brian, if you were having that type of conversation with somebody that's kind of right at that point in their life where they're thinking about pivoting from one phase to the other, what kind of things are you bringing up right now to say, hey, that's all right, we can still make this work? Is there certain data that you'd want to show that person to say, hey, don't worry, we can still move into retirement, we can start drawing on this portfolio even though the balances are lower than they were a year ago?
Yeah, so there's a math problem and a story problem. The math problem depends on the types of data that we're looking at right here, how the portfolio is set up, having some sense of what risk level of risk the client is comfortable with, and hopefully creating something that approaches an optimal portfolio where, because we don't know what's going to happen. It's the nature of things. So, increasing the probabilities as much as possible that you're going to have that comfortable scenario in the years to come. That assumes that you're just sort of this fixed human being and your goals are your goals, and even, more is better. The math, sitting along the math problem, is the story problem, where there are conversations between advisor and client in terms of, well, what's really driving the meaningful life for you? And this is where my research and writing and books have been sort of, where does money fit into a meaningful life? And one of the things we know through a vast amount of research, but also a little bit of common sense, is that when people enter the retirement / decumulation stage, they're leaving something behind that was deeply important to them for almost their entire lives, meaning work. So if you think about the deep sources of what makes life meaningful, there's a number of them, but one of them is competence or mastery, or that, that joy you get from doing something meaningful to you, that goes away. So the really good retirement counseling happens years before retirement, so that you not only identify the things that might make you fulfilled and content in those retirement years, but that you have a financial plan that gives you the flexibility to underwrite those things. So there's a lot, good planning is worth its weight in gold, although I don't know if that's the analogy I want, but you know what I mean, figuratively. Having those conversations well before you get to age 60, 65, 67 is critical, with the big cherry on this sundae that increased longevity, I think, all else equal, is a good thing. I mean, I want to live longer, but the fact that, it used to be you retired at 65, longevity got you to your late 70s, early 80s. Now people are comfortably living into their 90s. You've got, in many cases, 30 plus years to go. And the retirement challenge is multifaceted. It's a math problem, but it's also a story problem.
Right. Let's jump into our next topic. We talked about markets being down, which was a huge topic, but maybe even more noteworthy was inflation last year, right? And we're still looking at Fed meetings every time they happen, everyone trying to see what the CPI prints are. This first chart shows that CPI number. It's showing the year-over-year changes, right? So the purple one in the middle there is just the overall CPI print. That blue line at the top, that's showing specifically the change in food prices. And then the other orange one is core, which means they're backing out, I think, energy and food from that. So I guess the reason I wanted to talk about this and kind of break these apart, right, is because we keep hearing about inflation. We keep hearing about how gasoline is more expensive, or you go to the grocery store and eggs are more expensive. It seems to me that most of the people that we're talking about in a forum like this, anybody that is using a wealth advisor or a financial advisor, probably has enough assets, enough financial well-being, that the cost of eggs, the cost of gas is not a really meaningful impact on their financial well-being. Now, if we agree on that, then we say, is this still a topic that we need to be discussing with clients? And if so, why? And why are clients thinking about inflation when it's really not impacting their financial well-being maybe as much as the media or some of the stories might make them think it would?
Yeah. As someone who knows something about behavioral psychology, telling someone that their emotions are wrong is not good. I'm gonna stipulate that. So saying the way you feel is wrong doesn't tend to work. Um, so, and I love the question because this gets to a series of conversations we can have with clients about what's meaningful to them. So it's very true. If you've got a substantial income, if you've got substantial savings, yeah, you don't like seeing gas at $5 a gallon when it used to be 3 or 3.5. You don't like seeing a carton of egg cost $400 or whatever that number is up to. Now, I stopped eating eggs a couple months ago, I think. We know that from a dollars and cents point of view, that in some technical sense, it doesn't matter. No matter how expensive that gallon of gas is or that carton of eggs, you're going to be absolutely fine. So this actually raises the bar, or maybe puts into a very bright spotlight the importance of behavior, the importance of understanding client psychology. What's the question behind the question? Are they really worried about the price of gas? There's one narrative that cuts across much of what we're talking about that I haven't mentioned, which is that we generally like the sense that we're moving forward. We like the sense that things continue to go well. So even, it's why we see people who are very rich, they could be centimillionaires, they could be billionaires. They might be unhappy because the balances aren't going up, that they're maybe falling behind others or falling behind where their expectations are. The fact that many of our clients can afford that carton of eggs, but they're still very upset about it, to me, isn't a problem. It's an opportunity to better understand what's motivating them. And hey, does that implicate anything in the financial plan that might be tweaked?
And I was just reading one of the questions that came through, and I actually saw a couple kind of lead into the same question. So I'll ask it, and it's something we could probably get stuck on for a long time. So we'll try to keep the answer a little bit short. But you mentioned, as somebody who understands psychology, not to tell people that their feelings are wrong, but that's kind of what we're tasked with doing, right? Is saying, hey, I understand how you're feeling, but we can't let those feelings you're having make bad decisions or drive you to make bad decisions. So how do you have that conversation to say, your feelings are wrong? That's the question.
Yeah, and you want this to be a short answer, Caleb, or do you want to extend?
Well, let's get the short version.
Yeah, I think the short version is that empathy is always of value, and that trying to understand what someone is feeling and where they're coming from is job number one. If in fact it's leading them, just because I threw out the word irrational doesn't mean that we make poor financial decisions. But there are better and worse ways of framing a decision set such that you have made someone feel seen and heard, and still then give them a series of choices in which you are sort of nudging them in the right direction, because the relationship, the long-term viability of the relationship of you just being an order giver to the person across the table, especially if that one thing doesn't work, is probably going to cause some problems. If you can create an environment where they feel seen and understood, and you can build a choice set and a plan around that they have bought into, like, hey, we talked about this a year ago, we thought this might happen, our instinct might be to go to the right, but hey, we're going to go to the left. That doesn't guarantee anything, but the chance of success is that much higher.
I think that makes sense. So our last chart here on inflation is an interesting one. So every time we get into down markets, or we get into periods where people are afraid there could be a recession coming, or recessions get talked about, this is something that trends on YCharts. We get a lot of people looking at the misery index. Misery index is at the bottom there, plotted. All it is the inflation rate and the unemployment rate added together, with the concept being that if people don't have jobs and things are getting more expensive, they're more and more miserable, and that's not a good thing. The reason I thought this chart was interesting to put on here in the format that I did is if you break this indicator down, Any spikes in that kind of misery index as of late have been due to the inflation portion, where we're seeing, as everybody knows, historically very low unemployment rate. But also like that misery index number is pretty neutral right now. It's almost right in line with its historical average. So, if you say, hey, this misery index is a quantitative way to capture how people feel, and for me as a numbers person, that works. I say everyone probably feels fine. As you, who's much more in tune with people and how they're actually feeling, are people feeling fine because the misery index is at its historic average, or are the dichotomy between those figures more what's important?
No, they're not. So I was joking with you when we were talking, earlier, that there's the story of the guy whose head is in the oven and feet is in the freezer, and he feels about average. Um, no, it doesn't really work that way. And I'd quickly revisit this principle of loss aversion, the idea that losses are more painful than gains are pleasurable. And so there's always something. The top chart's really fascinating to me in terms of how the purple and orange lines, the inflation and unemployment lines flip at times. I think this is an opportunity for top shelf storytelling. So, having people understand that there's both good and bad news out there, that yes, there's the inflation story, but there's also the employment story. One is not particularly attractive, although according to these data, getting a little bit better. The other is kind of at an all-time great situation. Unemployment rates are at historic lows. So I think telling someone that it's average, so you should feel fine, you could predict, I don't think that's the best way to proceed. But taking an extra moment to tell the story of the way these things ebb and flow, and how we might use the good and the bad to continuously update the plan and make sure that we're headed in the right direction, there's something of value here.
All right, let's jump into our next topic here, housing data. I think this first chart is pretty interesting to me. So this purple line is showing the Case-Shiller house price index. The yellow line there is showing your mortgage rates, and when you put those things together, you get the affordability of housing. And I think we think about the housing market a lot when we think about buying and selling, and whether it's affordable to do so. Seeing this very stark increase in the value of homes, I guess the thing I want to understand from you is how do people think about the value of their home, right? You're in a home, you're staying there. It's whether or not it's affordable to go out and buy a new one, it might not make a whole lot of a difference to you if you're staying in your home. But I guess inherent feeling of your home being more valuable or less valuable, how's that affecting the investor? How are they thinking about that in terms of their overall financial wellness?
Yeah, I mean, I start by saying generally we have emotional attachments to our investments that have very little to do with the numbers at stake. And probably real estate, our primary home, would be the best example of that. But, we see it all over the place. For example, crypto over recent years, you have a culture or a subculture of people who are really passionate about this particular investment, and it becomes not only dollars on a balance sheet, it becomes a tie to a community. So there's a social feature, there's an identity feature to that asset. In the case of the home, which is a much much bigger thing than something like crypto, we absolutely have an emotional attachment. So when we see, if we're an owner and we see the value go down, that has a certain impact. If we're trying to buy and we see that the affordability gets worse and worse, that's going to cause a challenge. So again, I mean, so much of this ties back, Caleb, to, you did that really good research report on client communication. We don't talk to them enough. And when we do talk to them, we're often just spitting numbers. We are not born as calculators, we're born as storytellers, and people want story. And I don't mean BS like sales spin. I mean, let's understand the stories that people are defining their life by. And it is absolutely the case that for many people, where they live, with whom they live, who their neighbors are, the community that they're in defines so much of who they are, and they would rather lose money a little bit than versus some, you know, a more quote unquote rational rational decision. It's just part of how we communicate when clients, according to your own data, desperately want communication, and those who don't communicate well, those who don't show that empathy, they're just at a higher risk of losing that client.
Our next year just shows how sentiment on the housing market and new buyer traffic is approaching lows from 2007, 2008. I don't think we need to talk about that one in addition to what we just did. I think it kind of validates that statement. But the chart after that shows another kind of interesting story here, which is, again, tied to mortgages and that affordability thing. And you know, we hear a lot about the housing market and how it's difficult to go make a new home purchase right now. But I think what this chart shows is that it's actually people are in a great place with the homes that they have, the mortgages that they do have. The orange line here is showing the total mortgage debt, which is obviously the highest it's ever been. But the percentage of people's disposable income that's going towards their mortgage is actually very low. And mostly because people locked in low rates on their mortgages. So is this some good news? Is this something that could be brought up as like, hey, like there's actually some good news here in the housing market and where people live and replace their own mortgages?
Yeah. So we earlier kind of described 2022 as a bit of a mess. A lot of unprecedented outcomes, a lot, you know, and we say unprecedented, that's often code for just bad or negative. The fact is, plenty of good news is out there. You just, you know, you're pointing to, one of those data points here. We have positive data on the employment front. We'll talk in a bit about, you know, a pretty sharp market rebound. There is good news everywhere. Because of loss aversion and some other built-in biases, we tend to gravitate toward the negative because it does trigger a very instinctual survival instinct. So we're wired to pay more attention to what we see as dangerous. That's cool. That's like part one of being a normal human being. But in terms of our theme of client communication, better storytelling, the ability to say, hey, yeah, there's bad stuff, but there's good stuff too. And let's just accept that this is a messy world. And let's try to navigate all of that rather than overemphasizing one versus the other. It might even tie back, you know, when you posed, you know, when you grabbed a few of the listener question, the audience questions about, well, can't we just tell them that they're wrong? Well, we can't tell them that they're wrong, but we can tell them that, you know, the reality that is in our reality minus expectations happiness equation is actually a fair bit different than what they might be saying.
Yeah, I like that. Increase that reality variable.
Yeah.
All right. See, you were talking about the labor market, job market. You know, we showed that chart showing how you know, unemployment is at all-time lows. Contrast that with all the layoffs that have been happening at these very newsworthy big tech companies, right? So, you know, we put a little analysis together here at YCharts to say what are some of the very publicized layoffs that have been announced. We also talked about what the stock price has done since then. Maybe that's not so important, but how does this news affect people? You know, are they balancing this with the fact that, oh, it seems like everybody has a job based on the employment numbers, or is this creating some fear?
You know, I think it's a perfect segue from the previous conversation about something very different, housing, which is that there's good and bad news, right? There's the aggregate employment numbers, which are as good as they've ever been, just as the numbers go. And then you've got the most premier, almost by definition, visible, given that this is tech, this is social media. You know, these numbers look pretty ugly. I mean, there's a lot of layoffs. So it's a mix of good and bad. I'd also throw in there, and this is a little bit vague, but in some ways, technology is the optimism sector. It's the sector that's sort of the future. It's where we're going. And so for all of the terrible press that big tech has gotten, some of it well deserved, the fact is that we identify technology with the future, And when the future appears to be failing, we don't feel so good about it, even if there is the underlying, employment data that is quite constructive. So this is just sort of feel bad data. And probably the best we can do is contextualize it.
We'll dwell on it for just a second more. This chart I think is kind of interesting. It takes four of the biggest names on that list. It shows when they made their layoff announcements and how the stock price kind of performed after that. Obviously, a lot of market factors affect stock price, but you can see a pattern here that absolutely created some pressure probably to go in and make these news announcements after some of the reaction that shareholders saw from companies that did already make the announcements. So again, I don't know if there's a whole lot to talk about here if you had a big reaction to this one, but another kind of interesting picture on the same topic. All right. So big question. Are we in a recession? Are we headed from one? Let's acknowledge to everybody that neither you or I are an economist that can really answer this question. But the data is still fun to look at. It's still a fun debate to have. But more importantly, I think it's something that people are wondering, right? And they're asking their financial advisors, hey, are we in a recession? Is this a recession? Should I be worried? Going back to the question behind the question, right? This chart shows some of the things that people look at to determine, from a quantitative nature, are we in a recession? The first one is GDP growth, and the most, elementary definition of a recession is 2 consecutive periods of declining GDP growth or declining GDP. And we haven't seen that with nominal GDP. We have seen it with real GDP, which I think is interesting, and maybe adds to that sense of a feel of a recession coming on or having been in place. And then the lower one shows some of Enver's recession indicators like payrolls and industrial production, retail sales, all kind of trending upwards. But why are people asking this question? What's the question behind the question of, are we in a recession? Are we going to be in a recession?
Well, there's 2 questions behind the question. Am I going to be okay? And how much is enough? And so, this is very technical. And last time I checked, those able to make consistently accurate macroeconomic forecasts, there aren't many of them. And so I think this is about sort of what is the name on the book or the chapter, recession or not recession. I think what the conversation here really is about is all of the different pieces of a financial plan and having the opportunity to revisit the relevant parts in terms of job stability, the way you're planning for retirement, the way you're saving for your kids' college, all of the things that could conceivably be in a plan, which are infinite. So when we're asking about, is there going to be a recession? I think the real question is, am I still going to be able to achieve my goals? And, you have great data on this, Caleb. Like, many advisors just don't talk that frequently to their clients. And when they do, it's sort of a paper thin sort of rendition of some economic data. Here's the opportunity to go behind the nominal question and say, oh, okay, we have a plan in place. That plan is adaptive. We're taking in evidence. We're looking at the way that this could go. We don't know, but we're going to play the odds. We're going to do the best we can as probabilistic thinkers. And so let's talk about the dimensions of our life and how we've planned for it in this context. But, maybe it's controversial. Maybe people would disagree. I don't think many people actually truly care whether or not we're in a technical definition as defined by NBER or whoever.
We'll still debate it, though.
We will debate it endlessly because it's what we do.
All right. I'm going to skip the next chart, which just kind of shows where some of these indicators were at before and after prior recessions. And let's talk about a topic I know you like, Brian, which is kind of where people move their money, when they're feeling certain things about the market. So these pictures show how funds actually flowed in 2022. Looking at different asset classes and whether those asset classes saw big inflows from investors, big outflows, or kind of net neutral flows. And then over on the right, kind of more focused on the end of 2022 and seeing which sectors people are investing in. When you look at this data, what does this tell you about how people are thinking, feeling, and acting?
People are chasing performance. It's all that happens all the time. I started my investment career at Morningstar almost 25 years ago. So embarrassing to say that number out loud, but it's true. And so I do something slightly different now in the wealth management space with behavioral coaching. But, I've been looking at these data since the late 90s, early aughts. And look at all of this. Look on the left. Bonds were lousy last year. I mean, to have the big bond indexes down 10+% is jarring. And what did people do in response? They sold bonds. So as the market flagged, people ran away. And on the right panel, it's not a great outcome, but it makes perfect sense, right? Look who's on the left. Consumer defensive. It's in the name. Defensive, healthcare, energy. We chase performance. So behavioral finance 101 is the observation that we tend, the rule is, well, we should buy low and sell high. This is pretty, unfortunately, very good evidence that we do the opposite. We buy high and we sell low. Over on the right-hand side, the purple line, technology, we've already talked about what's been going on in that space. Real estate, rising rates, certain dynamics in the REIT market, that had significant outflows. Very much an indication that we collectively, as a community of advisors, can do a little bit better by not chasing the returns in the market.
And then the next slide here, I think even further emphasizes that people chase returns. They also run away from down markets, right? And they move to cash. And
cash, baby.
The big call out here.
Yeah, I mean, look at that top line on the left. Q4, $142 billion of flows into money markets. And I would juxtapose that with the middle line on the bottom graph, short-term bond. Short-term bonds are, not the craziest, most volatile investments in the world, but bonds generally didn't do well. And so now with the rise in rates, you see bond prices fall. And at the same time, your stable, safe money can go into a cash account at a 3%, at a 4 handle, whatever the number is. This is what we're seeing. As things got worse, it was a fear-based market. I've made that point many times. And in the context of a fear market, you go into cash and you can even see, the target date. It's interesting, the target date numbers on the top left, 20, 55, 60, 50, over, not in Q4 particularly, but over the year, it's like, okay, I'm going to step back. I'm just going to buy a ultra diversified portfolio, and I'm going to sit tight. So this to me screams, I got to get safe. I want to wait until the data is clear, and then I'm going to decide how to act.
Yeah, I think seeing those target date funds too, maybe it's encouraging to see that people with maybe 30 plus years to retirement, they're still putting money in that 401k. So I think that's where a lot of those folks come from.
Yeah.
So maybe it goes back to that chart of the investor versus the person drawing income, a little more confidence there.
Yep.
But all right, so talking about the market, in more recent market, the comeback. This chart shows, this red line is kind of the threshold for when we're actually in a bear market. Calls out some dates, and I know you've got something to talk about, here as far as like people still talking about a bear market that technically ended several months ago. But
yeah,
kind of weave into this the recency biases, right? Because we've seen a couple of questions come in from people on the webinar saying, isn't it our job as financial advisors to be telling our clients that long-term market returns are at a certain point? For a long time they were exceeding that point, so we're probably going to see a decline in the market, like we're going to see a mean reversion. But contrast that kind of long-term education with, an investor's actually recency bias, and are they thinking about that long-term number, or are they just thinking about what happened in the last month, 3 months?
Well, we saw in the flow data, prior to this, that for all that long-term thinking is one thing, doing is another. On the doing front, we're selling recent losers and buying and buying winners. So we're not buying low and selling high. What's interesting to me here is, and maybe this can address some of the questions that are coming in, if happiness equals reality minus expectations, part of our job is to clarify what is reality. And, we generally struggle with stories that change direction. So we've had this impression through much of last year, very volatile, losses were significant, that we were in a bear market. Your data here shows clearly that the bear market ended quite some time ago. We're here in February. Bear market ended in mid-October of 2022. Really good opportunity to update folks' reality, because we sort of do want to just glom onto that idea that, it's volatile and there were some losses. And even here in February, you're looking at your 2022 statements. It's not like it was that long ago. You're reviewing what took place. But the fact is that the reality is the real story. And what's cool about this data, the types of data you guys are producing, is that it allows you to so clearly state, hey, this is where we're at. It might feel a little bit different, but there's nothing wrong with marshaling evidence that gives people a fulsome sense of what's really taking place out there, and then managing expectations on the back of that. And I think we're wrapping up, but like the market performance, on the market performance side, things have been not so bad for quite some time. And we want to make sure that we're not chasing our tail. I mean, returns from market bottom, we talked about that mid-October date. Look at this, you got equities up, in the teens, you got bonds up close to 5% over that period of time. So it's very easy to not only invest, but to live life looking in the rear view mirror. But, to the audience comments about, yes, we are supposed to be educating folks about the long-term benefits. Well, that suggests buy and hold, not the table we saw with people bolting out of bonds, bolting out of higher beta equities, but just anticipating that at some point, no one knows the timing, but at some point, there's a reversion to mean. And we want to stay disciplined first ourselves, and then secondly, in coaching our clients to stay the course.
Yeah, indeed. And looking at this, return from market bottom, it's unfortunate we saw how many people moved to cash in Q4 based on those mutual fund flows. But no, I think this is some positive news to end on. Obviously there's you can take any time period on a chart or tell a story, but hopefully there's some good messaging to have out there. I really appreciate everything we've talked through. I know we're coming up on the end of the hour. I think it's great to take a step back from just being down in the data and building charts, and start to talk about what it means, how to talk about it with clients, how it's making them feel. And we probably could have spent several more hours talking about this, Brian, but just want to say thank you, and hopefully we can do this again soon.
Yeah, I look forward to it. This was great. Thank you so much.
Yeah, and if you asked a question that we didn't get to, we'll do our best to answer that offline. Remember, subscribe to our YouTube channel and check out Shaping Wealth, because they're doing great things with the firms they're working with too. So thank you, Brian. Thank you, everybody, for joining us.
Thanks, Caleb. Thanks, everyone.
Good weekend.